All right, so the title of my talk is Issued Assets Need Proof of Agreement. So before I start with the controversial stuff, let's start with what we should ideally all agree on, which is that we need consensus because we want to agree on transaction history in order to replicate ledgers of blockchains all around the world. And this replication improves robustness, decentralization, and interoperability. The next thing that I hope everyone agrees on is that most actual blockchains that are in use today achieve this consensus using incentive-based consensus, right? So these are mechanisms like proof of work and proof of stake, where you basically grant virtual coins to people as a reward for them doing things that make the consensus more secure, right? And there's some good benefits to this incentive-based consensus. One of them is that it lets people participate anonymously in administering this ledger. And because you have this open membership, it's good for censorship resistance. And then finally, another benefit is if you want to kind of give out your new cryptocurrency in such a way that there's a limited supply, but people believe it has value, then it turns out that consensus incentives are perfect for this. All right, so the problem is that this isn't really ideal when it comes to issued assets, right? So incentive-based consensus essentially requires people to believe that there's going to be some future value of some underlying cryptocurrency, right? And the main source of value that people are getting today out of cryptocurrency is just kind of appreciation of the cryptocurrency prices. And the primary value of cryptocurrency is actually paying the transaction fees on these blockchain transactions. And so what does this mean for issued assets that basically derive their value from some real world commitment by the issuer who created this asset on the blockchain? So this would be things like deposit-backed stablecoins, right? Or tokenized securities, real estate, carbon credits, loyalty points, basically anything where it's worth something on the blockchain because someone in the real world promised you could redeem it for something. So when you have these issued assets, they pose very different trade-offs from the kind of cryptocurrencies that we've been talking about. So one is that in a lot of situations, you really cannot subject the issuers to the whims of anonymous miners or stakers, right? If the Federal Reserve came and said, you know, tomorrow we're going to move FedWire onto a blockchain, and we're going to be moving $1 trillion of value around, you know, every day, you know, that needs to work regardless of what random miners might or might not do, right? And kind of in this situation, the primary utility that you're getting from the blockchain is really cross-asset interoperability, right? Anybody can on their own create, you know, PayPal and just have their own website and it's centrally controlled and that's fine. But it's when you want to issue a new asset and bootstrap that asset and have a liquid market in that asset, or when you want to trade between dollars and euros or, you know, PayPal to Venmo or whatever, that there's real utility in having this one place where you can transact across these different assets. The final thing to note about issued assets is that transaction fees are strictly negative in this model, right? If you're issuing some asset, like you're tokenizing some real estate, right? It's just strictly going to be less useful to you if there are higher transaction fees on that asset, because it means the secondary market in your asset is going to be less efficient, right? So, so the problem we end up with is this kind of Goldilocks problem of like, are the incentives of the blockchain right for the asset that you want to issue on there? And if you get it wrong and say you have a consensus failure, then you end up with an extremely costly double redemption attack on issued assets, right? You know, if you're moving $1 trillion a day on FedWire and that's on a blockchain, and you know someone manages to double spend an hour's worth of transactions, that's a lot of money that you've lost there. Or maybe there's not even monetary value, right? It's like, you know, it's like an NFT representing a parcel of land, and it's, you know, like you need that particular land. It's extremely bad to have confusion over who owns what. So basically, if your token transactions are too valuable for the underlying incentives, then you're going to have insufficient security in your blockchain. And conversely, if your token transactions aren't valuable enough, then you're going to have excessive fees for your transactions, or you're going to have like someone's going to need to be subsidizing this blockchain, and it's not going to be long-term sustainable, right? And so there's kind of a final problem with these incentive-based systems, which is that they tend to have anonymous administration of the blockchain by the miners or the stakers. And so that kind of like fails to take advantage of things that you could take advantage of, like say the reputation of someone issuing a token, or the fact that like as a society, we pay taxes and invest a lot in like protecting ownership rights and having courts where we can like, arbitrate, contract disputes and things like that, and where we have like regulations keeping our banks solvent and stable and so on. So to make this more concrete, let's look at some numbers. So this is from crypto51.app showing a bunch of proof of work blockchains. And the kind of second to rightmost column, you can see the cost to attack these blockchains, right? And you can see for Bitcoin, $1 million an hour, sounds like a lot, but again, if you're talking about something like Fedwire, like that's still not a lot. But then when you as soon as you start dropping off and like do anything but Bitcoin, the attack cost goes way, way down, right? And in fairness, you might say, well, there's one other thing which is keeping this secure. It's not just that it costs $1 million an hour to run a Bitcoin mining rigs. It's that like you've invested a lot in those mining rigs, and so maybe you don't want to kind of destroy Bitcoin. But the thing is that we're kind of hoping that these blockchains give us efficient markets in everything, right? So if someone is making $45,000 an hour mining, Litecoin, then like we should be able to like pay them $90,000 an hour to mine something else and therefore attack a blockchain like that. So this is worrisome for proof of work, but probably a lot of people here think proof of work is kind of passé, and where it's at now is proof of stake. So So let's look at some proof of stake numbers. And here I had to kind of pull values from different sources. So think about this more of like for orders of magnitude than like the exact numbers. But I took kind of a sampling of popular proof of stake chains. And if you look at Ethereum and you kind of look at the fees that people are paying, which is around $2 billion a year, and you divide it by the number of transactions, you come up with something like $5 per transaction, right? Now, of course, not all transactions need enough gas. There are periods where Ethereum transactions are cheaper, but there's also periods where it's more expensive. So that's kind of too expensive for a lot of applications, right? You're not going to build an app that lets you buy coffee on top of like layer 1 Ethereum, right? It's just not going to make sense. $5 is way too much more, fee for a lot of products. On the flip side, let's look at Algorand, right? There's $235 million staked. And, as we just learned from Sriram's talk, cost to corruption is like, 1/3 of that. So for less than $100 million, you could attack this. Of course, you could actually attack it for less than that because there's other things. Maybe you can like borrow the tokens, right? And so if you can kind of lever up by a factor of 5, we're talking about like maybe $20 million to attack this. And so the transaction fees may be lower, but again, that security is not going to be sufficient for, moving billions of dollars around on kind of an hourly basis. Now, if you look at most proof of stake chains, though, there's something else going on, right? So if we look at kind of Avalanche and Polygon for layer 2, Solana, you see there's a giant gap between the amount of fees that they're collecting each year and the incentives that they're actually paying out to validators. So what does that mean? Where does that money come from? Well, that money basically comes from cryptocurrency speculators. What's going on is, people are paying $17 million a year in fees, and then basically most of that is paid for through seigniorage, like creating these new tokens that are then sold on the secondary market, and crypto speculators are basically propping up the price so that the validators can collect $500 million a year. But that's not necessarily sustainable. Right? You can't rely on there always being these speculators for your security. Now, the final line is not a proof of stake system, right? This is Stellar, my blockchain. And you don't really stake anything there other than your reputation. We don't pay any incentives out to the validators. And not coincidentally, the fees are way, way less than any of the other blockchains. There's one of the absolute lowest price blockchains out there. All right. So what is this alternative that Stellar uses? Well, it's what we now call proof of agreement, right? And this is kind of what Sriram before me was calling, social consensus, right? If you can do social, if you can do social consensus, why do you actually need the proof of stake in the first place, right? So what we're trying to do is essentially formalize that social consensus, and we're going to call that proof of agreement. And so the basic idea is you have a bunch of validators in the system, and each validator specifies quorum slice, which is basically a set of nodes that says, these are the people I really want to agree with, right? So maybe if I'm transacting and getting paid in USDC, I want to make sure I agree with like the validator that USDC is listening to when they process their redemption request. And that guarantees that I'll always be able to, when I think I've gotten paid in USDC, I'll always be able to redeem that. And so basically here we've got, some nodes at the top form a quorum. At the bottom, you've got a quorum slice. V1 is saying I'll only agree to stuff that V2 and V3 do. But V2 and V3 are saying I'll only agree to, what V4 agrees to. So essentially you can only proceed and reach consensus when everybody's been mutually satisfied that the set of nodes agreeing on something includes their validators. And I'm not going to get into a lot of details of the protocol, but we do have a paper at SOSP 2019 that you can look at for the details here. At a very, very high level, though, the construction that we have for this proof of agreement is called the Stellar Consensus Protocol, SCP. It's been in production use since 2015. And the high-level idea is that validators sign messages saying, hey, I want to choose transaction set, T, and by the way, my quorum slice is such and such. But that wouldn't be robust to like nodes being down. So we actually let nodes choose multiple quorum slices and say, hey, I'll agree to any one of these. My quorum slices might be, 2/3 of the validators run by this company plus 2/3 of the validators run by this other company, or it might be 2/3 of the companies I think are important, whatever it is. And so the point is you proceed in this protocol when you have a quorum, which is a set that includes at least one slice for each member of that set, right? So there are some subtleties required to get liveness. So of course, you don't just want to say choose transaction set T because everyone might propose a different transaction set T. So we use a trick from Paxos, which is we go through ballots. And before you can say what you want to choose in a ballot, you first have to agree that nothing conflicting was chosen in a previous ballot. And then there's a second trick we use, which is that when you vote to choose something in a ballot, you actually have to send a message first the way you want to vote, and then you wait to hear enough votes, and you say I've heard enough votes, and that it's basically allows you to ensure that by the time you act on information, you're guaranteed that all the other kind of nodes you care about will also eventually hear that. So there's some other benefits here. We've got very low computational costs, low energy consumption, low latency. And there's a lot of fancy crypto that's cool on blockchain, but we don't need any of that. It's just digital signatures and hashes. Very kind of rudimentary stuff. All right, so to give an example of this protocol in action, the way the Stellar network happens to be configured is that there's kind of a tier 1 of validators who kind of obey certain norms. And then there's kind of other validators in the system that want to agree with those, but the tier 1 validators don't necessarily care about the lower tiers, which is a lot like how peering works in the internet, right? So no one appoints a top tier of tier 1 ISP, but the market decides that there's tier 1 ISPs. So here, for the sake of example, let's say the top 4 retail banks in the US become the tier 1 on Stellar. You might look at this and say, wait a sec, I don't trust those banks. Like they might rip me off the first chance they get. And the nice thing about this protocol is that doesn't matter. That's okay. If V7 and V8 here believe that these banks might rip them off, but they say, hey, we know we have to agree with the banks. We just don't trust them not to do something funny. You can just expand your quorum slice to include other nodes. So maybe V7 and V8 say, well, we want 1/3 of these, nonprofits over here, which we think are unlikely to collude with banks. And these nonprofits their quorum slices might require 2/3 of the nonprofits and 3/4 of the tier 1 and so on. Now, to see why this would protect you, imagine that one of these banks, like Citibank, tries to mount a double spend attack, right? So Citibank goes to V7 and says, hey, V7, here's $1 billion. Give me, your $1 billion diamond or whatever, and I want to walk away with it immediately because this is, finalized on Stellar, right? So V7 is going to say, okay, I want to make sure I'm in a quorum. I need 2 out of these 4 top tier nodes. Check, I have that. I need one of these nonprofits. The nonprofit needs 2 out of 3 nonprofits and 3 out of 4 here. That all works out great. I have a quorum. I agree this transaction's been finalized. You can have, this giant diamond, right? And so then the reason that V7 is protected is suppose that, these big banks are evil and they walk up to V8 and say, hey, V8, we want to, buy a fleet of airplanes from you for $1 billion. And, we're going to send it to you on Stellar. It'll be finalized and whatever. And V8's going to say, okay, but in addition to, these 2 out of 4 top tier nodes, I need one of these nonprofits to agree. And Stellar and EFF here, which believe the money went to V7, are not going to agree to this, right? Because they think that this is an attack. But maybe V8's unlucky and, sees the ACLU, and the ACLU was kind of straggling and didn't hear about the previous block. But the thing is that the ACLU's quorum slice depends on at least one other nonprofit, right? So basically, ACLU is going to say, I won't buy this unless these guys do. V8 then will not be part of a quorum, will not fall for this double spend attack, and so will be protected. All right, so the good thing about this model is you don't have to have a validator node to build a product or to issue a token on top of Stellar. But it's a good idea to at least to designate or run your own validator once your Stellar becomes important to your project, right? Everything starts small and then scales up if it's successful to something a lot more valuable, right? And so once you have significant value riding in your project on Stellar, you can run or designate a validator, and that will let you protect yourself against double spend attacks. It will give you a say in the governance of the network. And here's the thing: you don't need a bunch of money to stake, right? All you need to do is run a full node, which you probably want to do anyway, just have access to data. And if you turn on validation, that basically is no more expensive than running a full node. There's not really a cost, an additional cost to validating. You just have to issue a few digital signatures. And of course, Stellar lets you unilaterally stand up a validator at any time. There's no waiting period. You don't have to accumulate tokens to do it or whatever. And as long as your project has value to the ecosystem, other people will want to make sure that they don't disagree with you, right? So they will include you in their quorum slices. Of course, if you're not important, if you're just some random person, then like other people won't care, but you can still make sure that you don't disagree with other people by putting them in your quorum slice. So what about layer 2 scaling? Well, so layer 2 can definitely massively increase the number of end user transactions. And maybe doing that would reduce the per transaction fees, right? Because you're aggregating transactions that happen on layer 1. But the problem is that security depends on incentives, right? And from that point of view, we don't really care about the distinction between layer 1 and layer 2, right? So what Sriram was calling the profit from corruption is going to increase with the number of transactions in flight, which now is going to include all of the layer 2 stuff, right? So what that means is you're still going to need to grow those incentives kind of proportional to the value of all the volume that's happening on all the different layers. And so that means someone's still going to need to be paying a lot of money to these layer 1 validators, and it might, again, you're back to this Goldilocks problem. Now, in case what I've said so far isn't controversial enough, let me point out that actually a lot of popular blockchain applications that we think need to happen at layer 2 don't actually need to. We can do them at layer 1. And this is some really exciting research that Jeff Ramsayer has done right here at Stanford. One thing he's already shown is that DEXs and payments, things that we've thought needed to move off chain, actually don't need to, right? So he built this DEX called SpeedX, layer 1, completely scalable, right? Can get hundreds of thousands of trades per second. And if you want more, just add more CPUs to it, right? So that paper was at NSDI last year, so you can look that up. And not only that, but he's shown you can do the same thing for smart contracts, right? So you can have smart contracts. They're not quite as general as the smart contracts we have, but they actually accomplish most of the things that you want to do with smart contracts in a completely scalable way. Essentially, anything can scale if you can make the transaction semantics commutative. And it turns out that far more applications are actually possible in this commutative model than people think, right? So people are going off and building layer 2s for stuff that they don't necessarily need to. Now, can this be done in a way that's backwards compatible with existing layer 1s? Probably not, right? Some of the SpeedX, for example, relies on, concurrent C++ and like hardware level atomics and whatever. But the nice thing is that if you're going to build a layer 2 that's not compatible anyway, why not build a layer 1 that's not compatible? And the point is you can do that with proof of agreement because you don't need some huge amount of money to be staked in order for people to believe the consensus, right? As long as the primary value in your system is intended to be for issued assets, then you don't need to, then you can just stand up a new layer 1. So in summary, incentive-based consensus is very good for cryptocurrency and kind of pure DeFi, right? If you want to replace your big expensive vault full of gold with a bunch of Bitcoin, that's great. You want proof of work. If you want to play poker with people over the internet and have it be like impossible for anyone to cheat, Ethereum is going to be perfect for you. And the thing about these pure cryptocurrencies is that if the blockchain forks, it's not a big deal. You can fork Bitcoin into Bitcoin or Bitcoin Cash, and it's fine. Afterwards, everybody owns one of each, so nobody can really complain, right? It's not like forking a claim on a real-world asset where you'd be unable to duplicate the underlying real-world asset. So when you have issued assets, though, then the incentive-based consensus becomes more problematic, right? And so if you are working with these real world kind of issued assets, I've argued that you should stake your reputation and not cryptocurrency, right? That by having validators be known entities that can be sued, entities that are standing behind a particular token, which they have to do anyway if the token has real world value, you can basically you can kind of formalize this social consensus, and you don't need the proof of stake or the proof of work anymore, right? So the nice thing about reputation is it grows with the value of your product, right? So it just kind of naturally scales there. It's nice that you don't need to lock up capital. Nice that if your product is successful, you don't have to share revenue with other validators, right? Because the fees are lower, so you can keep more of the revenue that's coming from your actual product. And finally, there's no need to assume risk from anonymous validators. Like you could literally issue $1 trillion CBDC on Stellar tomorrow, and as long as you run your own validators and keep those secure, that model would completely make sense. All right, thank you. I'll take questions.